Trump just cautioned Iran. Silver up $5, oil up 4%, war within weeks. The former president just cautioned Iran. And the world didn't just listen, it reacted. Not in press conferences, not in diplomatic cables, not in the carefully worded statements that governments issue when they want to appear calm while quietly panicking behind closed doors. The world reacted where it always reacts first, in the markets. Silver didn't wait for confirmation. It moved $5 instantly. Oil didn't ask questions. It jumped 4% silently. And somewhere in the corridors of global finance, institutional money is already moving to places most people will only discover weeks too late. The Strait of Hormuz, 20% of the world's oil supply, one miscalculation, one wrong move, and everything you think you know about prices, supply chains, and your business changes overnight. The question is not if markets are pricing in conflict. The question is, are you? Welcome to Financial Crisis. Explained. The one place where we don't sell you comfort, we hand you clarity. Now, before we go any further, if you've been watching this channel for a while, you already know what's coming next. But if you're new here, think of subscribing to this channel. The same way a wise person over 50 keeps a spare key, hidden somewhere safe. You don't think you'll need it until the day you absolutely do. Hit that subscribe button, because the videos we make here are not the kind you stumble upon twice. And one last thing, drop a comment below right now. Where in the world are you watching this from? Are you in the Gulf, watching oil prices like a hawk? In Europe, feeling every cent of that energy cost? In Asia, watching the Shanghai premium quietly widen? Or somewhere in the Americas, wondering why your supply chain feels just a little more fragile than it did last year? Tell us where you are, because this story affects every single one of those places differently. Now, let's get into it. The former president just cautioned Iran, and the world didn't just listen, it reacted. Not in press conferences, not in diplomatic cables, not in the carefully worded statements that governments issue when they want to appear calm while quietly panicking behind closed doors. The world reacted where it always reacts first. In the markets, let us set the scene precisely, because in economic analysis, context is not background noise. Context is the signal. When a sitting or former president of the United States, the single most powerful political figure on the planet, directs a public caution toward Iran, markets do not wait for journalists to explain what it means. Markets do not wait for think tanks to publish white papers. Markets do not wait for your business advisor to send you a carefully formatted email on Monday morning. Markets move in milliseconds. And this time, they moved hard. Silver, a metal that most casual observers still associate with jewelry and old coins, surged $5 in a single session. That is not a normal trading day movement. That is a market screaming that something has fundamentally shifted in the risk landscape. Oil climbed 4% before most business owners had finished their morning coffee. These were not random fluctuations. These were not technical corrections or algorithmic glitches. These were the footprints of institutional money, pension funds, sovereign wealth funds, hedge funds managing billions, quietly repositioning themselves before the rest of the world understood what the caution actually meant. This is where most people make their first mistake. They hear a political statement. They form an opinion about whether they agree with it. They argue about it on social media. And while they are busy forming opinions, the smart money is already 3 moves ahead. Now, let us be precise about what Trump's caution to Iran actually represents in economic terms, because this is not a political conversation. This channel does not deal in politics. We deal in consequences. When the United States issues a direct caution to Iran, it activates what analysts call a geopolitical risk premium. This is the additional cost that markets automatically begin pricing into assets that are sensitive to Middle Eastern instability. It is not emotional. It is not speculative in the traditional sense. It is the market's rational acknowledgement that the probability of supply disruption has just increased. And 2 assets respond to this signal faster than almost anything else. Oil. Because Iran sits at the edge of the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's entire oil supply travels every single day. Any escalation involving Iran is, by definition, an escalation involving global energy infrastructure. A 4% jump in oil prices is not just a number on a trading screen. It is the market calculating shipping costs, manufacturing overhead, logistics expenses, and consumer prices, all at once, in real time. Silver. And this is where the story becomes particularly interesting for serious observers, because silver's $5 surge tells a more complex story than oil's movement. Silver is not just a precious metal, it is simultaneously an industrial commodity. used in electronics, solar panels, medical equipment, and defense technology, and a monetary hedge against instability. When silver moves this aggressively while gold moves more modestly, it signals something specific. It signals that institutional money is not just seeking safety. It is anticipating increased industrial demand in a conflict-adjacent environment, while simultaneously hedging against currency and economic uncertainty. That divergence between silver and gold is not accidental. It is a message. And learning to read these messages is precisely what separates businesses that survive geopolitical disruption from those that are destroyed by it. But here is the detail that most analysts glossed over in their coverage of this market movement. The Western silver spot price and the Shanghai futures premium had already begun quietly widening before Trump's caution made international headlines, which means someone somewhere already knew the caution was coming, and they were already positioned. The question that every business owner, every entrepreneur, every serious economic observer must now ask themselves is devastatingly simple. Were you? What an escalation actually means for global business infrastructure. There's a body of water. Most people have never seen it. Most people could not point to it on a map without hesitating. And yet, every single morning when you fill your car with fuel, every time a cargo ship carrying your imported goods leaves port, every time an airline recalculates its ticket prices, that body of water is already involved. It is called the Strait of Hormuz. And right now, it is the most economically dangerous 21 miles on the entire planet. Let us establish the geography first. Because geography, in economic warfare, is not just background information. Geography is destiny. The Strait of Hormuz is a narrow channel of water sitting between Iran to the north and the Arabian Peninsula to the south. At its narrowest point, it is approximately 21 miles wide. That is it, 21 miles, a distance you could drive in less than 30 minutes on an open highway. Through those 21 miles flows approximately 20% of the world's entire oil supply. Every single day. Tankers carrying crude oil from Saudi Arabia, the UAE, Kuwait, Iraq, and Qatar pass through this corridor like clockwork. Remove that corridor from the equation, but even temporarily, and the global energy market does not just experience disruption. It experiences paralysis. A 4% oil spike in a single session following Trump's caution to Iran is not the market overreacting. It is the market doing precisely what it is designed to do, pricing in probability. And what the market is currently pricing in is the very real possibility that those 21 miles could soon become contested territory. Now here is where the conversation must shift from geography to your business, because there is a dangerous assumption that most entrepreneurs and business owners unconsciously carry. It is the assumption that geopolitical events happen over there, in televised war rooms and diplomatic summits, in the kind of places that feel entirely disconnected from quarterly revenue targets and supply chain spreadsheets. That assumption has destroyed more businesses than bad management ever has. When oil moves 4% in a single session, it does not stay on the trading screen. It travels, quietly, systematically, through every layer of the global economy, like a slow-moving current that most business owners only feel months after. It has already reshaped everything beneath them. Consider the cascade precisely. Oil prices rise. Shipping costs follow, because every cargo vessel, every freight carrier, every logistics company on the planet runs on fuel. Shipping costs rise, import costs follow, import costs rise. Manufacturing overhead follows, because raw materials, components, and goods all move through supply chains that are entirely dependent on affordable energy. Manufacturing overhead rises, consumer prices follow. And somewhere at the end of that chain, your customer is standing at a shelf, doing quiet mathematics in their head, deciding whether your product is still worth what you're charging for it. This is not theory. This is the documented anatomy of every major oil shock in modern economic history. During the Gulf War of 1990, oil prices doubled within 4 months of Iraq's invasion of Kuwait. Businesses that had no direct connection to the Middle East, retail companies, food manufacturers, small logistics operators, found themselves absorbing cost increases they had never modeled for. Many did not survive the adjustment. During the 2019 drone strikes on Saudi Aramco facilities, a single incident lasting less than 24 hours, oil spiked 15% overnight. Global supply chains shuddered. Insurance premiums for Middle Eastern shipping lanes increased immediately, and companies that had built lean, just-in-time supply chain models suddenly discovered that lean supply chains have no tolerance for geopolitical shock. We are now operating in an environment that is significantly more fragile than either of those moments. Post-COVID supply chains have not fully recovered their redundancy. The Ukraine conflict permanently restructured European energy dependencies. Inflation has already compressed consumer spending buffers in most major economies. And now, a direct caution from the United States to Iran has just been issued. The system was already stretched, and someone just pulled the rope tighter. But here is what the oil price movement alone does not reveal. There's a secondary market signal hiding inside this story that is arguably more important than the oil spike itself. A signal that most business owners will never read because they are too focused on the headline number. That signal is in the silver market. And specifically, it is in the gap between what silver costs in the West and what it costs in Shanghai. That gap has a name, and that name tells you exactly where this is heading. What the smart money is actually doing. Right now, forget everything you think you know about silver. Forget the jewelry. Forget the coins. Your grandfather kept in a wooden box, wrapped in cloth, labeled with dates you never bothered to read. Forget the Hollywood image of pirates fighting over silver treasure. Because the silver that moved $5 in a single session is not that silver. It never was. Silver in the modern global economy is something far more complex, far more strategic, and far more revealing than most people, including most business owners, have ever been taught to understand, and that ignorance is expensive. Let us begin with a fact that Wall Street rarely explains clearly to the general public. Silver is the only major asset on the planet that simultaneously occupies two entirely different economic universes. In the first universe, silver is an industrial metal, not a decorative one, an essential one. Silver is the most electrically conductive metal on Earth. It is irreplaceable in the manufacturing of solar panels, electric vehicles, semiconductors, medical imaging equipment, missile guidance systems, radar technology, and advanced defense electronics. There is no synthetic substitute that performs at the same level. When defense budgets expand globally, as they inevitably do in periods of escalating geopolitical tension, silver demand does not politely increase. It surges. Because the machinery of modern conflict and modern defense infrastructure runs, in part, on silver. In the second universe, silver is a monetary hedge, a hard asset that human civilization has used as a store of value for over 5,000 years. When currencies become uncertain, when inflation accelerates, when the geopolitical environment threatens the stability of paper-based financial systems, silver absorbs that anxiety and reflects it back as price appreciation. Now here is the critical insight that most analysts missed in their coverage of this week's market movement. Both universes activated simultaneously. That is not normal. That is a signal of extraordinary clarity, if you know how to read it. When silver surges $5 in a single session, while gold rises only 1.6%, the divergence is not a coincidence. It is a message written in market language that serious economic observers must learn to translate. Gold is purely monetary. Gold has virtually no industrial application at scale. When gold rises, it means one thing. Money is seeking safety from uncertainty. That is the only story gold ever tells. But when silver outpaces gold by the margin we witnessed this week, it means the market is telling two stories at once. Story one, uncertainty is accelerating. Capital is rotating into hard assets as geopolitical risk premium expands across global markets. Story two, someone is already anticipating increased industrial and defense demand in a conflict-adjacent environment. Someone is positioning for a world where defense manufacturing accelerates, where energy infrastructure requires rapid reinforcement, where the industrial consumption of silver increases precisely because the geopolitical temperature is rising. The smart money does not react to conflict. It positions before conflict becomes headline news. And this week, it positioned loudly enough that anyone paying careful attention could hear it. Now let us examine the detail that should stop every serious business observer completely in their tracks. Western silver spot price, $77. Shanghai silver futures, $88. A premium of $9. This is not a rounding error. This is not a temporary arbitrage inefficiency that will correct itself by Tuesday morning. A $9 premium between Western spot and Shanghai futures pricing on silver represents something deeply significant. It represents the fact that Asian institutional buyers, sovereign entities, and state-adjacent purchasing operations are willing to pay a dramatically higher price for silver right now than Western markets are currently reflecting. Ask yourself why. The answer is not complicated once you understand the strategic context. China, the world's largest manufacturer of solar panels, electric vehicles, and advanced electronics, is also the world's largest industrial consumer of silver. When Shanghai futures price silver at a $9 premium above Western spot, it means Chinese institutional buyers are not waiting for the geopolitical situation to clarify before they accumulate. They are accumulating now. They are paying a premium now. Because in their calculation, waiting will cost far more than the premium they are paying today. And then there is Bitcoin, down 1% in the same session that silver surged $5 and oil jumped 4%. This single data point dismantles an entire narrative that the cryptocurrency community has constructed carefully over the past several years. The narrative that Bitcoin is digital gold, a safe haven asset, a hedge against geopolitical uncertainty and institutional risk. This week, When genuine geopolitical risk entered the room, Bitcoin did not behave like gold. It behaved like a risk asset. It sold off. Not dramatically, not catastrophically, but directionally. It moved in the wrong direction for a supposed safe haven. While silver was absorbing institutional flight to safety capital and simultaneously pricing in defense demand, Bitcoin was being quietly reduced in portfolios that needed to demonstrate conservative positioning in an uncertain environment. For entrepreneurs and business owners who have allocated portions of their treasury or reserve capital into cryptocurrency as a geopolitical hedge, this session was a data point worth studying with considerable seriousness. But here's the layer of this story that is most important for the business community specifically. The Shanghai premium, the silver surge, the Bitcoin rotation, the oil spike. These are not isolated events occurring in separate financial compartments. They are chapters of the same story. And that story is about capital. Enormous, institutional, sovereign-level capital, quietly but systematically moving away from assets that are vulnerable to geopolitical disruption, and toward assets that either benefit from or survive what may be coming. The question that no analyst on television will ask you directly, but that this channel asks you now, with complete seriousness, is devastatingly straightforward. When the smart money moves this clearly, this quickly, and this consistently, what exactly is your capital doing? Building a business framework for geopolitical uncertainty. Let us be precise about something. Before we go any further, this part of the conversation is not about fear. Fear is for people who are not paying attention. This part of the conversation is about something far more valuable, far more actionable, and far more rare in today's economic environment. Preparation. And there is a difference between those two words that quite literally separates businesses that survive geopolitical disruption from businesses that become cautionary tales referenced in economic textbooks that nobody reads until it is already too late. Let us address the central question that the title of this video places directly in front of every serious observer. War within weeks? Here is the analytical truth that most commentators will not say clearly, because clarity in the media landscape is less profitable than ambiguity. It does not matter, not in the way you think it matters, because the business community, the entrepreneurs, the supply chain operators, the capital allocators, the young professionals building companies in an increasingly unstable world cannot afford to structure their strategic decisions around the binary question of whether conflict materializes or not. That is a spectator's question. Preparation is not a prediction. It is a posture. And right now, the cost of being unprepared has never been higher, not because war is certain, but because the system within which your business operates is already absorbing the financial consequences of escalating geopolitical tension, whether the tension resolves peacefully or not. Oil at 4% above last week's price is already real. Silver at $5 above last week's price is already real. Shipping insurance premiums quietly rising across Middle Eastern trade lanes is already real. Supply chain managers across the Gulf, Europe, and Asia already receiving internal memos about contingency protocols is already real. The market has already decided that risk has increased. Your business strategy must now reflect that same decision. So let us build the framework precisely, practically, without panic and without the kind of vague advisory language that sounds impressive in a boardroom but produces nothing actionable on Monday morning. The first pillar is energy exposure auditing. Every business, regardless of industry, regardless of size, regardless of whether you believe you have any direct connection to oil markets, must conduct an immediate and honest assessment of where energy costs appear in their operational structure. Fuel costs for logistics and delivery, electricity costs for manufacturing and operations, heating and cooling costs for physical facilities, the energy embedded in raw material production and transportation, the fuel costs absorbed by your suppliers that will eventually be passed to you through price increases you did not model for. A 4% oil spike today does not stay at 4%. Historically, sustained geopolitical tension in the Middle East compounds energy costs across 60 to 90-day windows as contracts reprice, as shipping lanes adjust, and as the full cascade of energy-linked costs works its way through every layer of the supply chain. Businesses that audit their energy exposure now can hedge, renegotiate contracts, adjust pricing models, and communicate proactively with clients before the cost increase arrives uninvited. Businesses that do not absorb the full shock with no preparation time and no strategic options. The second pillar is supply chain mapping with geographic sensitivity. This is the lesson that COVID delivered at extraordinary cost to the global business community, and it is a lesson that a significant percentage of businesses learned temporarily, then quietly forgot as supply chains stabilized and urgency faded. The urgency is back. Any business with suppliers, manufacturers, or logistics partners operating in or routing through the Middle East, the Gulf region, or markets directly dependent on Strait of Hormuz passage must map those dependencies with complete honesty right now. Not next quarter, not after the next earnings call. Now, the questions are specific. If your primary shipping route becomes significantly more expensive or temporarily disrupted, what is your alternative? If your supplier's raw material costs increase 15 to 20% due to energy price escalation, do you have contractual protection, alternative sourcing, or sufficient margin to absorb the impact without passing unsustainable costs to your customer? If the answer to either question is uncertain, then uncertainty is your most urgent business problem, not your marketing strategy, not your Q3 growth targets. The third pillar is cash reserve positioning. Geopolitical uncertainty is, at its financial core, a liquidity event in slow motion. It compresses margins before most business owners realize compression is occurring. It increases the cost of capital as financial institutions quietly tighten lending criteria in uncertain environments. It reduces consumer discretionary spending as energy costs and inflation anxieties cause households to pull back from non-essential purchases. Businesses that enter periods of genuine geopolitical escalation with thin cash reserves and high leverage discover very quickly that the market has no patience for financial fragility during a crisis. The historical precedent here is unambiguous. During Gulf War, businesses carrying more than 60 days of operational cash reserves navigated the 1990 oil shock with strategic flexibility. Those operating on 15 to 20-day cash buffers, which was and remains common among small and mid-size operators, faced immediate and brutal decisions about payroll, inventory, and survival. We are in a world where 15 to 20-day cash buffers are dangerously insufficient for what the market is currently pricing. Now let us examine the dimension of this story that most analysts will deliberately avoid discussing because it is uncomfortable, because it sounds opportunistic in a moment that feels like it demands solemnity, because the business media has trained its audience to associate geopolitical crisis exclusively with loss, with disruption, with survival mode thinking. But history tells a more complete and more honest story. During every major period of geopolitical escalation in modern economic history, while unprepared businesses were absorbing shocks they never anticipated, a specific category of business was quietly experiencing the most significant growth opportunity of its decade. Businesses in energy infrastructure, businesses in defense supply chains, businesses in hard asset management and precious metals distribution, businesses in domestic manufacturing that could substitute for suddenly disrupted international supply, businesses in logistics intelligence and supply chain risk consulting, businesses in financial advisory services for capital repositioning. The Gulf War of 1990 created more American energy sector millionaires in 18 months than the preceding decade of stable markets had produced in total. The 2022 Ukraine conflict, devastating by any human measure, produced extraordinary returns for businesses positioned in European domestic energy alternatives, agricultural commodity trading, and defense technology supply chains within the first 90 days of escalation. Geopolitical disruption does not destroy all value equally. It redistributes value, rapidly, and often permanently. The entrepreneurs who understand this, who can read the signals clearly enough to position themselves on the right side of that redistribution before the mainstream narrative catches up, are the entrepreneurs who build generational businesses during moments that destroy ordinary ones. And this brings us to the final strategic insight of this analysis. The U.S. warning to Iran is not the story. Silver at $5 above last week is not the story. Oil at 4% above last week is not the story. The story is what these signals, taken together, are telling you about the next 60 to 90 days of global economic conditions. They are telling you that institutional capital has already made its assessment, that sovereign-level buyers in Shanghai are already paying a $9 premium to accumulate silver before the broader market catches up, that oil markets have already begun pricing in Strait of Hormuz risk, that Bitcoin's failure to perform as a safe haven in a genuine risk-off session has already begun quietly reshaping how serious capital allocators think about digital asset reserves. The market has already voted, the smart money has already moved. The signals are already written across every major asset class for anyone with the analytical discipline to read them clearly. The only question that remains, the only question that has ever truly mattered in every moment of geopolitical and economic uncertainty across the entire history of modern commerce, is the same question it has always been. Are you reading the signals, or are you waiting to read about them in the aftermath?